Hi guys, Henry here from Investment for Expats. I want to go over my portfolio outlook for 2024, speaking as of the 3rd of January 2024. And this is an email that's sent out to clients going over what to look out for in 2024. Just going back a bit to the reverse end of 2023, what we saw is very data dependent. This was particularly the case of December 12th on the Fed meeting when Jay Powell they said that they're looking better optimism, 6 rate cuts in 2024, and the markets acted very positively for this, as you can see in the graph below, showing the US unemployment, the GDP, and go here, the S&P's increase in December. They were on a kind of 8-week rally. It's just recently, as the speaking ended, but what you've seen is a rally on inflation data. Now, what does this imply for your portfolio, and what I think may potentially want to do to particularly mitigate this risk in 2024, or kind of go against what is macroeconomic data, a market that is specifically driven on macroeconomic data, is particularly inflation data. What you could see is it just revert just as quickly as what it has done, as it's gained if any negativity comes into the inflation data. So what we would look for in 2024 is the earnings of companies. These are likely to decrease as the monetary policy increases, has a lagging effect. So we look for companies with good quality earnings, profit margins, balance sheets. For those that have been in kind of the Nasdaq or the S&P 500 and seen significant gains in the S&P 500, what we've recommended is to reweight potentially into longer dated intermediate bonds, US investment grade bonds. We do actually see these as having quite a good yield. Make the most of it while they last. Particularly if you go into bond funds, the total return with the increase in the bond price, as well with a decrease in interest rate, would likely to have a significant effect on that. So look to reweight into that. If you do want to obviously look at the gains, what we said is stick to the US market. That's where it has. We've reweighted a lot of portfolios out of Europe, and Japan's also looking quite pricey right now. One sector that I'm particularly bullish on is the healthcare sector. A lot was talked about AI in 2023, Nvidia's share prices. What also may be a beneficiary of AI is actually pharmaceutical biotechnology. Maybe a bit of a lagging effect, as it may not be a primary recipient of AI, but it will catch up. Now, what we saw in the US healthcare sector, as we've seen here, is it actually declined. One of the few sectors to decline in the US market, which saw the US market up 24%, the healthcare sector. But if we take a more granular look at what's the components of the kind of big pharma, the BMY, look at the value. J&J, also another kind of stable stock that a lot of people have in their pensions for dividends, low beta, etc. Again, it's trading at quite a lowish value, and also with these stocks, you do get a bit of a dividend. Last one, Pfizer. I've talked a lot about that in the past. I think it's showing great value right now, and also it's got a near 6% dividend. What I can say on Pfizer is that, and BMY, is that they are making a number of acquisitions. They are increasing their pipeline. They are sat on a lot of cash as well. So you can see by these charts here, kind of the value that those farmers, to large cap pharma is showing. Here's the value of pharma, which analysis think it's fair price. I do think that's a bit high, but realistically, you could expect it to go to kind of mid to late 30s and still have that dividend. So I do think Pfizer's a good potential option. For those that are just looking more generally, what I've recommended is just go into kind of the US healthcare ETF to diversify the risk. Talking regionally on ETFs, proposed in December, the ASX 200 in Australia, it was presently at 7.1. It's now at kind of 7.6 as of talking. I do still think this has legs in 2024, but we won't go in it specifically. More bullish on the Asia Pacific developed markets, ex Japan, as an ETF. what came out yesterday is a lot of fund managers, I think 60% from the source of Bloomberg, were looking at China or Hong Kong, just because it's gone down 60% in 2 years. I'm actually in that camp. I've been on it for a few years. It's been wrong in 2023 when it went down significantly. I do think it still has a lot of legs to give. And if you want more developed markets with a bit of diversification in, say, Australia, that also will benefit from the China's kind of growth, this may be an ETF for you. Also, what we've seen as of today is China just, again, doing more kind of stimulus packages to boost the economy, and this will have kind of lagging effects, positive lagging effects on the economy in 2024. So hopefully the GDP figure reflects that in kind of the late part of 2024, and markets may react accordingly. So there you have it. There's my update for 2024 for portfolios, where I'm looking at specifically where I look to reallocate, reweight portfolios tactically. I hope you found this useful. And if you do have any questions, feel free to email me at info@investmentforexpats.com, or our website has www.investmentforexpats.com. We have over 500 blogs on kind of wealth management and cross-border wealth management.